Hi, class. This is Dr. Barbara Gast. This is in week 8. I hope you're doing well and that you will enjoy our guest speaker this week that we'll be talking on personal finances. Meanwhile, I want you to be reading chapter 15 in our textbook, and we're going to go over some of the accounting concepts. Some of this you'll be hearing again and again, so bear with me here. We want to first start with the idea of why we need these financial reports. It not only produces information that's useful to your business, but we have to meet legal and contractual relationships. And in order to measure our achievements, we need to have these kind of records. We've talked about cost, revenue, and expenses the previous week. And just again, to reiterate, cost is the value given to obtain something that you want. Revenue is your accumulated income, and expense is the decrease in your equity caused by consuming whatever materials or cash that you have. So we've talked about assets, liabilities, and owner's equity. And I think you can see where the asset and the formula that we talked about last week was asset equals the liability and the owner's equity. So these are basic concepts so that when you read a financial report, you understand better what they mean. We're moving into the phase where you need to develop a budget. And this is a financial plan for the future. It's not what's happening right here today. We can use what we think. If you have a past year or years, you can use that as your base. But when you're starting out a company, for instance, you will have to estimate. So the budget is going to be that plan that's based on a single level of operations. Each department will have their own budget, and all the budgets will go up to the top, to the chiefs. So if we're trying to plan for the future, it is going to be quantitative use of resources. And as you recall, there's 4 resources, okay? Time, people, money, as well as equipment. So how are you using those resources to achieve your strategic goals? So one of the activities I will have you do when I return, that will be October 28th, but I want you to be thinking about it because there are forms that are offered. You can take a look at those forms. They're called Pro Forma, and you can look at the slides that's in week 8 for chapter 15, and you'll see actual samples of the Pro Forma. And this is your hypothetical information. We're not doing it just for a make-believe company, but in a real-life setting, you still have this hypothetical. This is what we think we're going to be using next year. These are best guess estimates. Again, so we like evidence-based decision-making, so what we're looking for is some hard data that kind of supports where we're coming up with these figures. In our case, we're just going to have to estimate. Sometimes throw a dart and say, we'll start there and see where it goes. Your projections are adjusted for growth. If you want to grow the company, sometimes we're contracting, saying we've overreached and we want to bring it closer in. There can be seasonal variations, and I've given the example of the turkey operation. So you don't want all the turkey production concentrated in the last quarter of the year, but try to spread it out throughout the year. So what we'll be doing in groups, and because you don't have the advantage of meeting with your group, you can get a leg up if those of you have the opportunity. You want to take the time that you normally meet in the class and meet together as a group. You could try to do that, but it's not required. You're going to be making sales projections. And what that means is over a 12-month period, you're going to try to estimate how much revenue you think you're going to bring in. Now, we have to start somewhere. And it's not unusual that you wouldn't have any revenue the first month or couple months. It depends on the product. If you have a service, it's going to take a while to build up your clientele. So we usually see it start out small and then grow to the 12-month period in a startup company. If you're going to project, you're going to have to think about these seasonal fluctuations. For instance, like the university, they're closed over the holiday, the Christmas holiday. So there would not be anyone paying tuition fees during the holidays. So those are the kinds of things you contract or adjust or expand as your production or service requires. There's another step in this, and that is you're setting your price per unit. And I can't stress that enough. You have to identify what is a unit. For example, if I'm selling olive oil, I could sell olive oil by the container. Say, here's a glass jar of olive oil, and I could sell that. That's my unit. I could put it into a carton, a box that would maybe have 12 or whatever configuration you want. And that would be your unit, a cart. You could sell it by the pallet and say, so on the pallet, we have so many boxes, and we're going to sell you price per pallet. So there's the various ways you have to identify what is your unit is, and that's how you're going to price it. You also are going to have to estimate startup costs. And that what we mean by that is that you will try to figure out, are you going to own the building? Are you going to rent the building? Do you have what kinds of investments you're going to have to put in? You have to buy desks, chairs, things of that sort. You can be very creative in the way that you want to approach this. For instance, you could simply say, we're going to go to Goodwill or to an auction and buy furniture, and then we have very minimal costs. Right. So it's important, what I'm trying to stress here is that being able to estimate exactly what our needs are financially, and the more accurate we can be with that, the better prepared we are. I'm going to reiterate one more time that the first year of operation for a startup is the most critical, and that's when they go out of business. It's not as easy as you think you have enough money, but you don't. So again, usually estimate on the higher side so you don't run out of money. We may have to go in debt, what we call debt financing. And so this is how you substantiate your reasoning for getting those funds, either to a bank or investor, whatever it might be. All right, this is the beginning. I just wanted to touch base. These are short lectures you can see in 15 minutes or less. And then I'll keep posting these lectures, and hopefully they will work for you. All right, if you have a question, reach out. I do respond. It may take me a couple of days, but I will respond to you. If not, go to the business office and they'll be able to help you. All right, take care.